David Westin, the host of Wall Street Week, standing by right now with the former Secretary of the Treasury, Larry Summers. David.
Thank you so much, Romaine. Yes, Larry, thank you so much for joining us. Larry, of course, is our special contributor on Wall Street Week every week. And Larry, last Friday, you and I talked some about what's going on in banking. A lot has happened since then, particularly in Washington, with the Federal Reserve and others really stepping up to really guarantee deposits. What do you make of what is going on? And specifically, what do you think that will mean for the Federal Reserve? Because there's a lot of movement in the market about what they think the Fed is going to be up to.
David, I think the authorities over the weekend did what they needed to do. It was clear that if there wasn't assurance put behind deposits, both deposits in the failed institutions like SVB and deposits in other institutions, that you were going to have enormous chaos this week. And I think by guaranteeing the deposits in the failed institutions and by providing support to the whole banking system, they have at least taken very substantial steps to contain what otherwise could have been a panic. We're going to have to see how this plays out from here. I'm sure there will be more financial aftershocks. Markets have radically revised their view of what the Fed's going to do. They now think rates will be substantially lower at the end of the year than they are right now. None of us can know. My own judgment is that it would be a serious mistake for the Federal Reserve not to remain focused on its objective of containing inflation and bringing it down to the range of the 2% target, and that's probably going to require monetary policy to become more restrictive than it is right now. Now, the hard thing to judge is that when banks are nervous and scared, as they surely are in the wake of what's happened, they lend less. And so we've already had some of the monetary tightening that the Fed thought it was going to have to deliver. So it's going to have to make a judgment about how much more monetary tightening to deliver that reflects what is happening in credit markets. I think markets have quite possibly overstated that adjustment. My guess would still be that it will be appropriate for the Fed to move by 25 basis points at its meeting next week, though conditions are always subject to change. And I think that it's imperative that the Fed remain focused on inflation. If the Fed doesn't remain focused on inflation, the ultimate consequence will be higher interest rates, and that will mean more of the kind of financial dislocation we saw last week.
Larry, there was a time about 2 weeks ago that you were saying that we should at least have the open possibility of 50 basis points. From your point of view, is that sort of off the table, at least in this time of turmoil?
I wouldn't take anything off the table right now. We're going to get important numbers on the CPI. We're going to see how financial markets move and evolve over the next week. Certainly, if a decision had to be made today, I think with all the surrounding uncertainty, it would not be sensible to make it a 50 basis point move. But I think that there's no reason why a decision does have to be made today. And I think, as much as has ever been the case in my memory, this is a time when the Fed needs to keep its fingers on the pulse of the economy and make judgments only at the moment when they have to be made and on the basis of all the available data.
Larry, one of the things that we saw over the weekend is a special lending facility, if I can put it that way, from the Fed. They opened the window for all banks, as I understand it, with the fairly favorable terms. Is it consistent to be doing that at the same time you have quantitative tightening? Or let me put it the other way around. Should the Fed be considering coming off the quantitative tightening right now?
No, I think that the two are really separate spheres of policy. David, the motivation behind the Fed's lending program is not to support the bond market. The motivation is to provide liquidity to banks so that their customers will know that their money is safe and good within them. And I think that's an important objective and something that in current circumstances is probably necessary for the Fed to do. I think that's quite separate from the question of what the overall level of rates is. And I think there the Fed has created an enormous amount of liquidity and has a very large balance sheet. And some normalization, I think, is appropriate. But I don't think those two policies are in contradiction with each other.
Larry, you've been quite outspoken and direct about the fact that the Fed took too long to start tightening monetary policy, let inflation really get somewhat out of control. At the same time, looking back on it now, is it possible, having gotten started, they went too far too fast? That in fact, they did in the end break something? Is that what we're seeing over the last few days?
I don't think that's the right interpretation. What broke Silicon Valley Bank was highly problematic risk management practices at Silicon Valley Bank. The fact that they borrowed money very short term and put it in long-term securities. The fact that they relied for funding on highly unstable, uninsured deposits. The fact that all their business activities engaged people who all had dinner with each other every night, the tightly knit Silicon Valley community. And so they were prone to being the victims of groupthink. That's the lesson here. It's a lesson about banking and how to run a bank in a healthy, sound way, not a lesson about monetary policy.
Larry, I know you've done a fair amount on Silicon Valley. Do you have any particular relationship with Silicon Valley Bank? I mean, did you know this was coming? Did you see it coming?
No, I didn't. I was aware of the existence of Silicon Valley Bank, and no doubt companies I had something to do with had something to do with Silicon Valley Bank, just because so many companies there did. But I didn't have a close relationship, any real relationship with Silicon Valley Bank, and I wasn't studying or poring over their accounts.
Right.
I have to say, when this came to light, I was struck by how clear it was if you did look at their basic accounts. But that's not something I had done before.
Larry, finally, you've been in the room, certainly at the Treasury when you ran the Treasury as Secretary, also when you were chair of the Council of Economic Advisors in the White House, when certain really crises came up. Give us a sense of how a decision maker, whether it is Janet Yellen in the Treasury Department or Jay Powell at the Fed, how they decide not to go too far. Because if they overreact to these situations, they can cause even more concern, right?
I suspect every leader is different. My own experience and the people I worked with, Secretary Bob Rubin, Secretary Lloyd Benson, Chairman Alan Greenspan, Presidents Clinton and Obama, their approach was to get someone to state clearly what the problem was, what the rationale for action was, to attempt to lay out the various possible actions with their pros and cons, and then to try to choose a direction. And having chosen a direction, we're going to close SVB and we're going to guarantee its deposits and we're going to provide liquidity to the rest of the system, then to turn to the tactics of the strategy that had been selected and try to think them through as carefully and clearly as possible. So it's an approach of identify the problem and the objective, choose a strategy, optimize the tactics given the strategy that's been selected.